Well, I think there's sentiment, and then I think what the actual economic transmission of what the Fed is going to do from a rate perspective are two different things. So, if we're actually sitting here at the end of the year and we're at 225, think about the areas of growth in the economy and how restrictive that would be. We have plenty of room to move as it relates to financial conditions. Our friend Liz Young put up a great chart on Twitter earlier today showing how much further financial conditions could tighten to get us back to pre-pandemic levels. And I think what we need to think about is, where does that growth come from? We're also entering the third year of this bull market. And frankly, the range of outcomes in the third year of a bull market that we've seen historically has been a narrower range of outcomes. And so if we think about it in terms of potential volatility, if you think about it in terms of where do we go in the second half of the year, and to Joe's point, into next year, certainly seems like we're going to have higher equity prices, and that's where you're going to want to be. But I don't think we're looking for, or we aren't necessarily looking for, another blockbuster year as we had last year. So I think investors need to be realistic about the types of companies, the industries that could potentially continue to grow their earnings in the second half of the year. I think an emphasis on quality and fundamentals is going to be much more important. And to Degas's point, the economy is slowing down, but there is a big difference between an economy slowing down based on comps over a pandemic period, as we saw last year, versus an economy that is truly slowing down because we've peaked. And I think that we need to accept slower growth, but that doesn't necessarily point to a recession. So watching the yield curve, watching the 3-month and the 10-year spread is going to be important. But I think, again, being selective about what industries you think are going to benefit, perhaps not on the input side, but on the end product side in the second half of the year, is your best bet in being properly positioned.